Hey guys, I hope you're doing well. It's H-Invest here. Today we're going to be analysing McDonald's. This company piqued my interest recently. Main reason being this. So I didn't realise this, but when I was looking through McDonald's, just as a business model, purely out of curiosity, I saw negative turnover for the past 7 years. And that really got me intrigued because you wouldn't expect it with a company like McDonald's. I also saw that the price to earnings ratio was the highest it had ever been, up in the early to mid 40s. I think it was 42 the last time I checked. And these graphs really piqued my attention. So let's do a bit of a deep dive on McDonald's and see if it's a good business to buy at the moment. I hope you guys enjoy the video. Okay, so what is going on here? When you look at these two graphs in isolation, the classic value investor would say, what are you doing? This would be the last stock that you'd want to buy. Of course, this is only one part of the story, right? If you think about what profit is, there's more elements than just turnover. You've got your turnover and your margins, right? And if one of these things goes up, that can result in more profit. So that's basically what's been happening with McDonald's. Whilst turnover has been going down, and I don't like that fundamentally as a sign for a business. Maybe if it's like a value opportunity with a PE of 10, but generally turnover going down isn't good because you're having to rely on higher and higher margins. That's basically what McDonald's have done. You can see higher and higher margins going up pretty much in the same past 7 years that turnover's been going down. And that has resulted in earnings per share getting a massive boost. It's not been a smooth ride, but yeah, you can see there's a long-term trend from EPS, and that's been driven by massively growing margins as turnover has declined. So here's the long-run share price of McDonald's. No surprises, it has been going up in the long run. The past 2 years, it's also gone up quite a lot. This graph is very similar to the general pattern of most of these mature, what Peter Lynch would call stalwart companies in the S&P 500, from early 2020 when the stock market was good, COVID crash, and then massive market recovery as the liquidity comes in, bit of sideward trading towards the end of 2020 when we're all going back into lockdown, particularly for a company like McDonald's, right, which, all of these mandates mean that McDonald's business operations are severely reduced in these lockdowns, and then, going up into 2021, some increased volatility, but an upward trajectory nonetheless. And if you compare it to the S&P, you can really see there's a very high correlation between McDonald's share price and the S&P share price. As I said, McDonald's underperformed in this period of late 2020, when we saw resurgence in COVID, winter in most of the world, so hospitals were being overwhelmed. We hadn't had mass access to the vaccines yet, they were only just being rolled out. But McDonald's is still up 33% since January 2020, which is crazy despite some of the headwinds that it's seen. S&P up 45% since January 2020, which is also quite crazy. A lot of people are saying, it's just these top companies, Tesla, Apple, Facebook, not so much Amazon, but Google, the ones with the large market caps driving this S&P up. That is true to an extent, but we can see McDonald's, it's one of these mature companies, obviously hasn't been growing much in the midst of the pandemic, and you can see it's still up 33% in the last 2 years with COVID headwinds to deal with all the way through that. So it's not just been these big tech companies that are going up, and McDonald's has only underperformed the S&P by 12% and still grown by 33%, which I find a pretty crazy statistic. So that's the other component to why its PE is so high at the moment. It's not just being adversely impacted by COVID, but also the share price is up massively. McDonald's is known as a dividend aristocrat. If you haven't heard of this term, dividend aristocrat, it's basically a publicly traded company that has consistently paid its dividends every year to its investors for the last 25 years. McDonald's wipes that threshold to the floor with 44 consecutive years of dividends, which is absolutely crazy. But, is this sustainable for McDonald's? Do they still have this premium? Well, if we look at some of the dividend stats, It's not looking good for the yield. The yield is at an all-time low, at least in the last 15 years. Yield of 2%. A big component of that is obviously the share price increase. The price and the yield have an inverse relationship, obviously. The payout ratio is very, very, very high. You know, we're bordering on 85%, which is not great. It was a massively low earnings year for McDonald's last year, so that's why we're seeing the high payout ratio. I'm probably being a bit unfair to them. Their kind of long run payout ratio is in the 60 to 70% range. And the dividend cover, again, it is not great for a company McDonald's, you know, 1.2, 1.3. Whilst this is a mature company, you know, they have a history of growing their dividends, which obviously they have to spend their free cash flow on that. You know, expanding operations, so that's more and more capex they're going to have to spend on, buying back its shares and paying out its dividends. So there's a lot to balance here with McDonald's. It's not a company that can just chuck all of its money into its dividends. So this 1.2 cover is quite low. As I said, it has been a bad year for McDonald's, given the COVID headwinds. But you can see back in 2018, they have a dividend cover of 1, and this is a downward trend. So it's not looking good for McDonald's on the aristocrat front. Okay, what is going on here? What is going on here? You've got these ratios at all-time highs. As I said, it's a mixture of the price being up 33% from pre-COVID highs, and earnings being down. So that's why you're seeing it across the board. EV to turnover, all-time high of multiples. PE, all-time high of multiples. EV to EBITDA, all-time high of multiples. You can actually see that these multiples are forecasted to go down massively in the near future, and this is because of very, very positive analyst expectations, even for turnover, which has pretty much gone down every year in the last 10 years. So we've got to try and figure out here, will there be this big turnaround in McDonald's, or, quite frankly, are the shares just overvalued and is now not a good time to buy them? Here is something positive that I did a bit of research on. So if you compare the turnover and the free cash flow in 2019, this is both from Q3 year to date. We're looking at 2019 versus 2021. 2019 to 2021, because I want to try and cut out some of that COVID adversity and see like where they are from, you know, before pandemic headwinds to kind of after recovery. I was also looking at Q3 because in Q1 and Q2, McDonald's still had quite a lot of COVID adversity that is now starting to clear up, and it is looking good, particularly for the turnover, which wasn't growing. If you kind of annualize this out, you know, they've gone from 16 to 17.2 basically, so that's 3.9% annualized, or an 8% changed overall. The analysts are forecasting 5.5% annualized, which is still, you know, it's still a bit of a jump to get up from 3.9 to 5.5. But remember, at the same time, this annualized jump was done in the pandemic, and they probably haven't fully recovered yet, right? There are places like Australia with still very authoritarian lockdown policy. The McDonald's are yet to see this rebound in turnover, right? Same with free cash flow. Free cash flow is looking good, and the analysts are forecasting the same annualized percentage growth as we saw in the differential between these two quarters in 2019 and 2021. Here's the kind of total picture. As you can expect, we've got this massive rebound. This is why also I put FY21 to FY23, as I'm cutting out this rebound and I'm looking at the growth from this projection to this projection. So it's kind of like non-COVID growth. So it's you know, discarding the rebound and say, you know, what are McDonald's going to grow normally when they've recovered and got back all of that revenue that they would have got in COVID, that they then, you know, collected in 2021 instead. So that's basically what we're looking at here. So this gives me much more reassurance than looking at, the earnings are down, the share price is up, you know, all of the multiples are at all-time highs. And you can see it graphed here, which is really, really good. You can see, obviously, lockdown slump. COVID became, you know, mainstream here in Q1 2020. Q2 2020 was probably the worst, with most of the world on lockdown. McDonald's, they've adapted to that well. Bit of adversity last winter, and now they've started to climb back into pole position, and you can see that they are, you know, above their pre-COVID highs in terms of quarterly revenue. Let's go over McDonald's business model real quick. These are all the countries with McDonald's, which I find absolutely insane. So when you kind of exclude Africa, we're talking the vast majority of the countries in the world, which is incredibly impressive to run all of these operations. And it just shows that no matter the culture, no matter the living standards of the country, McDonald's business model is surviving and thriving in these locations. So what is being done differently to warrant this growth? I know the growth has still been good on EPS measures, but that's been done by improvement in margins, right? And McDonald's operating margin is currently 37.5%. So you've got to think, how much can they really rely on that margin growth getting higher and higher and higher to fund growing earnings per share and growing free cash flow? It's not really where you want to be. You want to see that organic turnover growth as well. So one thing to mention is McDonald's have pushed prices up by 6% compared to the year. And that 6% is literally in line with the year-on-year inflation that we're seeing in the US. So in real terms, their prices haven't gone up, but in nominal terms, they're pushing it up 6%. And that's good. It's shown that, McDonald's, they do have this element of pricing power. But at the end of the day, you do have to worry a little bit because they do make money from being, a low-cost food service. So you don't want McDonald's having very, very high prices all of a sudden because it defeats the object and it defeats everything that their brand stands for. Other things though is the company do have a lot of really interesting stuff in the pipeline. They got a new CEO in December 2019. They've got this chicken sandwich which is being launched on a wide scale in 2021. The reviews from that have been very, very good. One of my favourites, Redeem Your Rewards points app, which is very, very positive for somebody like McDonald's because one of the disadvantages of the restaurant industry is switching costs. And I'll talk about this much more in the economic moat, but to have this kind of app that's going to keep people going back, I don't think you can reap the rewards from the app, i.e. collect free meals, until you've been at least 5 times. And I think that's perfect because 5 times is enough for people to say, right, I can go to McDonald's 5 times and then get the free stuff. People love free stuff. But it's not too much that people say, oh, forget this, I don't want to go to McDonald's 25 times before I can start reaping the rewards. So that's very, very positive. I think it's really, really great McDonald's are doing something like this, and it's being advertised on a wider and wider scale going into 2022. And also in 2022, they've got the launch of Beyond Meat, their McPlant burger, which is going to be very, very exciting. Preliminary results look very, very good. I've done a full stock analysis on Beyond Meat on my channel, if you guys want to check that out. It's a very, very interesting company, and it looks like, in the early stages, this Beyond Meat partnership is very, very successful, and we're going to see the results of that when it's launched full scale in 2022. So good to see innovation on McDonald's part. Do McDonald's have an economic moat? I don't want to spend too much time on this because, if you know anything about investing, McDonald's, of course, they got one of the most valuable brands in the world, and this does warrant a really wide economic moat. Not only is it a valuable brand, but it's a very valuable brand with children, right? I'm sure you guys have all had the positive experience going to McDonald's, getting the Happy Meal, getting the toys, collecting the toys, getting a nice milkshake. McDonald's have that, and they've been doing that for 3, nearly 4 generations of people now. So you have that positive experience of McDonald's as a kid, then you remember the brand growing up, and the whole brand gets reinforced. Those kids, they grow old, they eventually have children, and the cycle repeats itself. These golden arches as well. The brand is absolutely insane. When you're in a foreign country and all the restaurants are closed, or if you're driving down the motorway and you're hungry, even if you're not a typical fast food eater, there are many people that would see these golden arches and it will just give them a sigh of relief. Not because McDonald's food tastes amazing, but they know they can get a good meal that will fill them up, that tastes reasonable at a reasonable price. People are paying for consistency, and that's exactly what McDonald's gives them. They also have massive scale advantages, right? When you're a business of the size of McDonald's, you can negotiate massive deals because you're buying food items and commodities in bulk. You can get lower per unit costs, and also, when you've got access to such large free cash flow, if you're looking at getting prime location real estate, you can outbid your competitors quite easily because you have access to that massive amount of money. So being a big franchise like McDonald's, it's very easy to outbid local restaurants for prime real estate, which is exactly what McDonald's have done. What about risks? Every company comes with its risks. I think the risks to McDonald's are lower than most businesses, but they're still prevalent. I think the biggest risk with McDonald's is if you bought the shares at current prices, are you overpaying a little bit? Nonetheless, other risks, future lockdowns. I think this is a little bit of a risk. I don't think it's going to happen personally. Without getting into COVID too much, preliminary data on Omicron looks good. And I think that, governments are under a lot of pressure to keep core business open because businesses have suffered a lot through this pandemic. So I don't think we're going to see many more full-scale lockdowns throughout the world. I've certainly got my fingers crossed that we don't. But you never know. That is a risk. There's a risk related to lockdowns that I think are much more prevalent for McDonald's that I'm going to talk about in a minute. Health-conscious shifts. This has been shifts that we've seen, a slow but reasonably consistent shifts that we've seen for decades. People transitioning towards more and more healthy foods. It hit McDonald's a lot in the early 2000s, and they ended up bringing down some of the saturated fat and salt content of their foods, and they offered apples to kids in the Happy Meals. But at the end of the day, McDonald's is a fast food restaurant, and their foods aren't the healthiest, and this actually links into another more serious risk that I'm going to talk about in a minute. So let's put those to one side. The risk related to future lockdowns is the catalyzation of work from home. That's what I really think is going to be a big risk, is like COVID has shifted this massive work from home culture. And in many office jobs, both in the private and the public sectors, it's gone from, being at a desk 40 hours a week and having to go to lunch in your work facility to, we need you in the office once or twice a week for meetings, but we can now do a lot working from home. I think that's going to be a big risk because, if you can cook and more people are moving out to the countryside, there's going to be less need or demand for McDonald's services. I think a lot of people buy McDonald's because it's cheap, reliable in the city. The calories to price ratio is really, really high. People know what they're paying for. And it's a matter of getting quick, food in you and solving the problem of being hungry when you need to work. But if more people are working from home, there's not really going to be that issue. So that is a trend I really think we're going to have to watch for McDonald's going forward. That matter of efficient, quick food, it's not going to be as prominent among workers. I think it's still going to be prominent, among people that have had a night out or people going into cities for leisure purposes, but not so much among work purposes. Inflation, I wanted to quickly touch on this. McDonald's have dealt with it well by raising their prices by 6%, so the inflation hasn't impacted them that much this year. We still might see supply shortages, and if we see prolonged inflation for a long period of time, because McDonald's prides itself on being someone that can deliver reasonable food at a very cheap price, and they might not be able to raise their prices at the same rate as inflation. If we see this inflation persists at high levels for a long period of time. So also this is something that I wanted to link back to the health conscious shift is, in my life I'm seeing more and more restaurant competition. There's a lot more kind of small chains that are growing into medium chains that are giving people like McDonald's a lot of competition, and they are on the more expensive side but are also on the healthier side. And when you've got such low switching costs in the industry, and you've got people more and more health conscious, these restaurants, they might take some market share from McDonald's. It's just a trend to bear in mind. It is a trend to bear in mind. McDonald's have they've innovated. They've got the Beyond Meat Burger, which is healthier than its meat counterparts, but as far as vegan food goes, it's not the healthiest thing. McDonald's isn't a healthy place to go and eat, and there are healthier alternatives, and it is a bit concerning that McDonald's might lose market share to these healthier alternatives. And there's more on the market. There's way more chains on the market than there used to be. So McDonald's are going to have to compete with that and constantly, spend on capex and innovate going forward to retain their market share. Is the dividend safe? So I mentioned dividend aristocracy earlier on in the video. I think this dividend is safe for the time being. As I said, if McDonald's can rebound the way that we saw them organically rebound, excluding the pandemic, from 2019 to 2021, it looks good. If they can live up to the analyst expectations, then it's good. That's why the dividend payout ratio has kind of gone down to its long run average, because the analysts think we're going to see that massive rebound in earnings per share. So I think the dividend is safe for the meantime, but I think McDonald's do get a bit of a premium. You know, one for just being McDonald's and having that globally recognized brand value, and the other for being this dividend aristocrat. You know, and the yield only at 2.2%. There are other good deals in the market. It's much higher than kind of the average S&P yield, which I think is about 1.3, 1.4%. But 2% isn't impressive compared to a lot of these dividend aristocrats. So I think the dividend is safe, but not attractive. Here's the free cash flow forecasts that are massively going up. We will investigate this in more detail when we move towards the valuation, and kind of have a look at these analyst estimates, see if they stack up, and see if the shares are a good deal based on these estimates. But yes, if this free cash flow you know, does have this massive up, then the dividend looks very safe. If it does kind of trade flat, as we've seen in the past 10 years, it's not looking as good for McDonald's. Quickly on the cash flow statement, so you can see the rough upward trend for net profit, and then obviously the massive adversity that McDonald's went through in 2020 is dragging it down. Net cash from operations, that's been good until again 2020. What to say on here? CapEx was cut massively. We've got a lot of new borrowing being issued, much more than the repayment of borrowing. McDonald's, you know, maybe they're trying to take advantage of the low interest rates to leverage themselves a bit more, and also, you know, fund some of this new innovative projects they've got going on. But that borrowing is getting higher and higher. They've obviously got this dividend that they're paying more and more every year, which is going to eat into that free cash flow. And they've got this share buyback program to commit to, and they are going to have to keep committing to that when the rebound from COVID happens, because if they don't, then I think, you know, shareholders are going to go, you know, what's going on here? You've had buying back shares for so long, and now you're not really committing to it. You know, is McDonald's struggling a bit on the cash flow side? So it's not an amazing cash flow statement. It's interesting to see them take on more debt. Does it look sustainable? Well, it looks high. The interest cover is at an all-time low of just over 5. So, you know, pre-interest to post-interest, that's eating in by 20%, which isn't great. And the debt to free cash flow, again, at an all-time high of 11. So that is definitely something to watch in the future. You know, McDonald's don't get a bit more fiscally responsible over the next few years, they could find themselves in a position of massive over-leverage. Superinvestors, not much to report here. There's only 3 Superinvestors out of about 75 that Dataroma track that own McDonald's. Only one with a relatively significant part of portfolio. Robert Oldstein, you know, 0.71%, relatively small. And, you know, there's been mainly sales in the past 2 years. So there's not much positive activity going on in the Superinvestors other than Viking Global, which loaded up a 2% position. And I'm surprised it's only 3 Superinvestors for such a well-known company with such a large market cap. And there's also not much to report with insider activity. There have been quite a lot of massive sells and not many buys amongst management at McDonald's. Let's have a look and compare McDonald's to other companies in the sector and see how they stack up. So we've got the negative annualized turnover, as I explained. Free cash flow trend was still positive, which is good. And you can see it's a bit of a mixed bag for a lot of these restaurants. Obviously, a lot of them have been impacted by the pandemic, so there's some that were flat that are now negative. There's some that were growing really, really well that are now growing slower. And it's general good forecast all round, which is interesting to see. Obviously, baked into that forecast, there is a bit of rebound, you know, from these pandemic headwinds. So we're going to have to bear that in mind. From a quality standpoint, McDonald's have the highest operating margin of the bunch by quite a long way. Very, very impressive operating margins. McDonald's is an incredibly efficient business. They do that very, very well. But high operating margins is a blessing and a curse. It's a blessing because, yes, it's a very efficient business, but it's a curse because they've relied on margin growth for so long, and can they keep it up when the operating margin is already 40%, right at the top of industry? Can they really do that? That's a big question. Return on capital employed and return on invested capital, they both look good, nice and high. If we look at the multiples, you know, McDonald's, they have a massive EV to turnover multiple, which isn't really much of a concern for me. Because they have high margins, they deserve that EV to turnover premium. EV to EBITDA, again, you know, middle of the bunch. They don't look particularly cheap, but then compared to some of these other companies, they're not that expensive either. And if you look at it a year ago, this is my concern, is that it's, you know, what, 1.6, 1.7 times. It's not quite double, but it's approaching that area of its EV to EBITDA 3 years ago. Does it warrant it? Does it really warrant it when McDonald's have had massive headwinds? They've had shrinking turnover. Analysts are really forecasting massive turnarounds in that and crazy growth in free cash flow, but it's yet to be massively seen other than when we compared Q3 2019 to Q3 2021, and we saw an annualized rebound of about 4%. Employees, so a lot of the employee count has increased on these restaurants, but employees for McDonald's has actually halved, which I think is probably on balance a good thing. I know a main reason why that's halved is because they've kind of switched to self-service and orders and improved on efficiency. So I think that's a good thing, cutting their expenses. So yeah, on balance, I think that is an efficiency save and another factor as to why they've increased their margins by such a large degree. Okay, we're now going to go over the valuation to have a look at the numbers and see if McDonald's are a good deal at current market prices. Okay, McDonald's discounted cash flow. I've decided I'm going to do these without the camera, by the way, just so I can really like focus on the numbers and be a massive nerd about staring at the spreadsheet. So you can see the turnover growth. Yeah, as we said, there's been a massive downward trend in the past 5 years. Here's the COVID headwinds. Free cash flow growth, again, it's been pretty flat, to be fair with you. It was in this rough upward trend, but now we've seen this. But the analysts are forecasting this, 7,146, which is a huge rebound on what we've seen before. And that is partly coming from turnover growth. So the analysts aren't just relying on, you know, insane margins going up to 50% plus to warrant this free cash flow growth, which is promising. You can see in the past the like average turnover. Yeah, okay, let's do it excluding COVID. Excluding COVID, the average turnover decline here was you know, minus 4.6%. The average free cash flow growth, however, even in fact excluding COVID, it was 10% annualized from here to here. So we do have to give McDonald's that. Is that there was pretty positive free cash flow growth, but as I said, that mainly relied on improving margins, and you know, they're already at 37.5%. So how much higher can they realistically go? Forecast, okay, this is turnover it's including the pre-COVID, right? So it's basically taking out all of this volatility in the rebound. So they're forecasting 5% annualized turnover growth. So look at this. You've got the 6%, you've got the 5% there, and then that compared to that is about 5% annualized, which is what we saw them do here. You know, based on these forecasts and based on the actual Q3 results as well. So that is positive. Free cash flow, including all those years, is at about 8%. So when you factor all that in, these analyst forecasts don't look that insane. You know, if the new innovation that McDonald's has goes well, it looks okay. But, you know, when you put all of these estimates in, you're getting a fair value of $147, which isn't great, with the share price at $262. That's 44%, you know, overvalued based on this model. And you've got a long run growth rate of 2.5%, and WACC is 7.4. They came out actually probably exactly what I would put at for McDonald's. You know, it's a pretty low risk company. It's not low risk enough for me to go 7% or under, because it does have its headwinds, particularly with COVID. But it's lower risk than the general market, which is returning, you know, 9 to 10%. So discounting it at 7.36, I'm very happy with that. But the shares are massively overvalued when you do this kind of calculation. If we put all of this into a matrix, and also what's happened here? Let me just shift these cells up. Yeah, if you put it into these, if you put it into this matrix, there we go. you can see, based off different scenarios for annualized free cash flow growth, pretty much is overvalued in all scenarios. You know, you'd have to get 12% annualized free cash flow growth at 6% discount rate for the shares to be undervalued right now. You know, bearing in mind this does include the post, you know, COVID boom, but you want to be conservative, right? You say, okay, maybe like 2 or 4% is like very conservative. This is like bear case scenario that, you know, we go back into lockdowns and McDonald's innovation products don't work out quite well. But 6 to 8% is more the range where I'm comfortable with, and we're not getting any upside here at all. We really aren't. In order to get significant upside, by the way, I've also noticed this is out of kilter, so just bear with me there. Okay, there we go. You know, in order to get significant upside, you're going to have to go 16% annualized free cash flow at 6% discount rate, which is insane. And even the analysts up here, you know, with this annualized of 8%, including the COVID, excluding that, it's an average of 20, right? And you're still getting a 147. It's not good at all on the free cash flow perspective. If we go to EPS, so EPS, particularly with a mature company like McDonald's, you get a little bit less of a swing. You know, with DCF, I tend to find, excuse me, huge upside. This is Omicron coming in. Huge upside or huge downsides, particularly with a relatively, you know, slow growing, stable stalwart like McDonald's. You tend to get earnings per share more or less fair value, unless there's a big shock to the market. But McDonald's is coming out overvalued on this. If we use the 5-year PE of 27, that's an average of the last 5 years, which I think is generous, because before this, you know, McDonald's actual historic PE has been in the range of 15 to 20, right? It's not really been up here. This is kind of abnormal for McDonald's, these 25 PEs. But we've even put in 40 there. So we've used an average of 27. And if we use the analyst growth rates, which again, it puts in the rebound, and then it puts in these averages, which are similar to what the analysts are forecasting for turnover and free cash flow. We multiply that by the PE that we're going to use, and we're getting this for fair value for all the different years. When you average those out, you know, you're getting 238. It gives me a high degree of confidence because there's relatively little like variance in these targets. But that's 9% downside on the current share price. So again, it's not looking good from this method. And you know, also if you put in the EPS growth for the next 5 years at different PEs, you're looking at, in order to get any significant upside, 20% annualized EPS growth at a 40 PE to even get 30% upside. You know, in all the kind of realistic scenarios, again, 5 is very bearish because this takes into account the post-COVID rebound. You know, I would be more inclined to say, okay, fair play to them, let's give them 10 or even 15. 15 might be the most realistic scenario given the analysts, you know, they're forecasting average growth of 17%. Remember, excluding the 2021 rebound, that, you know, this is more in the kind of 8% range. They've just got this 55% jumping from, you know, COVID. So those are the ranges that we're looking at here. And again, it looks overvalued. You know, 15% growth of a 25, 30 PE, it doesn't look good. You'd have to keep this 40 PE of McDonald's up to get any massive upside. And I wouldn't be a betting man on that, considering that the kind of long run, you know, full cycle PE of McDonald's is actually in the range of about 18 to 22. We've seen a couple of years of 25 recently, and now we've seen a PE of about 40. So yeah, on evaluation, McDonald's doesn't look good at all. Okay, conclusion. Am I buying shares in McDonald's? It's so funny, I tried to say that with passion, but it's just so anticlimactic because you guys have just seen the valuation models. How could this value investor be buying shares in McDonald's? No, it's a no from me right now. So, as we just seen, the DPS, the DCF and the EPS models show that the shares are overvalued. Even with the analysts' optimistic growth figures, the McDonald's can turn itself around and actually pull EPS growth from turnover as well as margin growth, even though turnover's been going down for the last 8 years in a row. There are some promising future projects that we mentioned, the rewards loyalty program, Beyond Meat, that chicken sandwich, and they've got the new CEO, which is driving a lot of these ideas, but they look to be priced in. You know, as I said, we looked at the growth, expected analyst growth, and the shares were still overvalued when you do the valuation models, and you can see the EV to EBITDA at all-time high. So that if there is any upside from that growth, it's definitely priced in at the moment. It's not good enough as an income stock. The yield is 2.1%. There are historic highs of payout ratio. I'm sure that will go down if McDonald's do have the rebound that we're expecting. But the yield is just not exciting enough to buy solely for income. It's more, you buy McDonald's for growth, and then this 2.1% yield is an added bonus. Operating margin is 37.5%. As I said earlier, that's a blessing and a curse, because it's top of industry, but like, you know, McDonald's, they can't be in this position going forward where their turnover is declining and declining, and all of a sudden their operating margin, what, is it going to be 60-70% for them to keep growing their EPS? So that is something that concerns me a little bit. I know that there are more ways they can keep getting their business more efficient. Yeah, that is something that concerns me. You might be asking, can we short it / put option it? Yes, you can, if you're feeling very creative and very bold. I'm actually considering putting a small put exposure on this, which is why I mentioned it. But it's more if the shares keep rallying without these earning estimates being improved. I think it's very unlikely for these earning estimates to go even higher. But because we're getting such a correlation between McDonald's and the S&P, if the S&P keeps rallying, we might see McDonald's rallying. Why is McDonald's rallying with the S&P? Well, you know, it's large. It's a large component of the S&P. It's probably in a lot of S&P 500 ETFs, and you know, people just buy McDonald's because it's got this brand premium of being McDonald's. So with the influx of investors in the market in the past year, there's probably been a lot of interest in companies like McDonald's because they're very, very well known, and they're known for being stable. So the kind of more conservative new retail investors are probably buying shares in these kind of companies. If I were to buy put options in this, it would be small exposure, as I said, because I think there's probably, you know, 20, 30, 40, 50% upside on these put options, depending on, you know, what the volatility you want. Obviously, you can buy longer expiration put options, you know, to minimize that exposure to theta, but at the same time, then you're not going to get that same upside when McDonald's shares do tank. I would buy at the money though to maximize that volatility. There's not much short interest in it currently. As I said, I might open up a short position on a long put. I haven't decided whether I'm going to do it yet, and I will have more conviction to do that, you know, if these shares keep going up without earnings expectations going up. And I think that might happen because, I mean, look at this. We see such a high correlation with the S&P. So there we go. I'll keep you guys posted. But yeah, I hope you enjoyed that video and you found my analysis on McDonald's insightful. You guys take care. If I don't see you guys between now and Christmas, I'm sure you will, but if I don't see you guys, happy holidays. Take care of yourselves, and I look forward to seeing you in the next video.